Investors may use our discretionary risk management overlay, aka Dr. Mo, to implement a customized version of KISS or as a market timing and position sizing guide for factor long short bets. So this "or" is underlined in all caps for a reason. So let's start with our retail investor friends or investment advisor friends who may be using this table to implement a customized version of KISS. So let's say instead of 60, 30, 10 SPY, AG, and Bitcoin, you'd rather have something that looks like the Qs instead of SPY, LQD, investment grade credit instead of AG, or gold instead of Bitcoin, or in fact, you might want to diversify further instead of just having one equity position. You want to diversify into maybe 5 or 6 different equity positions across the sectors and factors, or 5 or 6 different fixed income positions across the different factors within the fixed income market. This Dr. Mo table will allow you to do that. And the only information you need from this table are, okay, what's the market regime, or at least the one that's focused on asset allocation, and then what's the BAM signal. The market regime will tell you how to implement the top-down risk management overlay for the equity, fixed income, and alternative exposures, the macro exposures that you implement in. And the BAM signal for each of these independent ETFs will tell you will give you an indication on how to implement the bottom-up risk management overlay. So again, all the information you need to customize KISS from that 60, 30, 10 SPY, AG, Bitcoin formula into something that's more suitable for your risk preferences or your tolerance or your strategic investment objectives. You certainly can do that using this table. Check out our KISS FAQ. As a matter of fact, if you're a client of 42 Macro and have not reviewed our KISS FAQ, you're doing yourself a disservice. There's a lot of good information, good process information there, irrespective of if you're following KISS. If you're following KISS, please read that twice. Just make sure, I guarantee you, every question you have on KISS is already answered in the KISS FAQ. So this is me telling you, please read the KISS FAQ. Specifically, if you're going to be implementing a customized version of KISS, there's a lot of specifics in terms of how to actually do that, how to accomplish that, what information you need to be using. And we're obviously making that information available to you on a daily basis in our Lead Off Morning Notes, and obviously on a weekly basis here in these Around the Horns. So getting past that, for our professional investor friends and our sophisticated retail investor clients, we use this Dr. Mo table as a market timing and position sizing guide for your own factor long short bets. And so all you need from this table are the proper trade recommendations. And so if an asset is bullish, and it should be bullish in this particular regime, Dr. Mo will recommend a long max position in that asset. If an asset is neutral, and it should be bearish in this particular regime, or sorry, the wrong one. Let me skip to a long half. If an asset is neutral and it should be bullish in this regime, Dr. Mo will recommend a long half position in that particular asset. If an asset is neutral and it should be bearish in this particular regime, Dr. Mo will recommend a short half position in that particular asset. And then finally, if an asset is bearish and it should be bearish in this particular regime, then the Dr. Mo will recommend a short max position in that particular asset. And then finally, if an asset is bearish and it should be bullish in this particular regime, Dr. Mo will say, don't do anything, don't touch it. Or if an asset is bullish and it should be bearish in this particular regime, Dr. Mo will say, don't touch it. So again, this is a very powerful tool, and it's a very simple tool that relies on some very unsimple math to help you stay on the right side of market risk. It's the easiest thing ever. All you have to do is look at the table and make changes if there are changes to be made, and don't make any changes if there are no changes to be made. For most of the time, we're in this major bull run in stocks. Dr. Mo was saying long max position in stocks, long max position in credit. It didn't change, so you didn't have to change. But when it changed in late June, if you didn't change in late June, leading up to this correction, then I'm guessing you probably learned a bit of a lesson here in terms of how to better implement the signals that we're providing. And so hopefully, we use this most recent period of market turbulence as a great, reminder that these tools are very effective and they work. Using Dr. Mo or even KISS, our BAM signal, which contributes to both KISS and Dr. Mo, got us out of Bitcoin right before it crashed over the weekend. Got us back in Bitcoin on Wednesday, right before the big rally on Thursday. It's doing its job. Now, that may be a little luck involved there, but again, if what's that famous quote about luck, Ben Franklin? I find that the harder I work, the more lucky I get. And that's a real. I think that's a perfect way to think about how to become a better investor. If you implement good process into your investment process, you're going to wind up being more lucky than investors that implement bad process or have no process at all. And we're really grateful for this example that we got in markets to remind investors that these tools work. And this is a great reminder here. We remind you in every presentation that these tools work, at least with the back test. And so we'll just quickly go over them for those who may be new. I'm suspecting we're probably going to have a lot of new clients after this week, just given the success that we had recently. The VAMS, our volatility adjusted momentum signal, which again is the primary tool we use to help investors identify trends and inflections in momentum across the various factors in the market, if you just pay attention to our VAM signal, you'll capture 96% of the upside in the stock market and 98% of the upside in Bitcoin. And if our VAM signal is bearish, you have a high probability of seeing those markets go down. And so obviously you want to be either short them or not long them from the perspective of being a retail investor. And so that's obviously incredibly powerful. You don't really need anything else. Everything else I'm saying is just to help you anticipate how the VAM signal is likely to evolve over time. If you look at our market regime nowcasting backtest, across the two risk on regimes versus the two risk off regimes, the S&P 500, 97% of the cumulative performance of the S&P 500 since January of 1998 has come when our market regime nowcasting process has indicated we're in a risk on market regime, i.e. Goldilocks or inflation in terms of this table. And only 3% has come when the market regime nowcasting process has indicated we're in a risk off market regime. You got more than the total amount of cumulative performance that we've seen in Bitcoin has come when we're in a risk-off market regime, and Bitcoin has gone down on balance when we were in a risk-off market regime. So these tools are incredibly powerful. That's why they are the dominant driver of all the pivots that portfolio pivots and asset allocation pivots that we are instructing clients to make, because again, they work. These incredibly powerful tools. You're not going to find more powerful tools, certainly not at this price point. Maybe, Izzy or Ken might give you access to some funds, but most of those funds are closed and you involved in them. So, we're grateful that you're here with us. So let's keep it moving here. And so, by the way, if you want to review the performance of our volatility adjusted momentum signal and our market regime nowcasting process, with respect to each of those factors that we feature in this Dr. Mo table, you can review that on your own time here on slide 22. But the key takeaway is that both our VAM signal, is optimized for each asset, and they backtest really, really well for each asset, as well as our market regime nowcasting process. It does a phenomenal job of keeping clients on the right side of market risk. I mean, just look at the change in the Sharpe ratios when you go from risk on to risk off, and that tells you that this system is working and it's very effective. And so it's not going to always be effective. There will be head fakes. There will be times where, like right now, markets aren't really trying to decide price in anything really aggressively, and so you got to use the human oversight to say, okay, let's make this determination and do this for now until we get more signal, more clarity. And that's part of my job as a macro risk manager. And hopefully I'm doing a good job. I think I am doing a pretty good job. Going back, I think we've had, if you go back to when we started this firm in April of 2021, I think you can count on one hand the number of macro strategists globally across all of global Wall Street that have had a better track record than us. We're bullish in 2021. We pivoted bearish in December of 2021. We were bearish all the way until January 2023. We've been bullish by and large since January of 2023. We were ragingly bullish from last November to June of this year. And we appropriately got clients to start taking down risk and risk assets, starting in late June all the way through July before the correction. And then we got clients to start appropriately increasing their allocations to bonds starting in early June and increasingly throughout July before the big run up in bonds. And so, without taking a bow, we're just going to say the reason we're having so much success and we've had such sustained success is because we have systematic processes and procedures that have proven, that rely on proven quantitative techniques, and they work. And when they don't work, we learn from our mistakes and we incorporate those learnings into future iterations and evolutions of those models, or we get rid of things and add new things. And ultimately, at the end of the day, the reason this process works is because it works. Let's keep moving here.